Hello, everyone, and welcome to today's webinar, ESG and the Accounting Profession. My name is Danielle Lee. I'm Managing Editor at Accounting Today, and I'll be your moderator today. Before I introduce today's speakers, some CPE information for you. Horizon is pleased to be able to offer CPE for this web session. It is imperative that you adhere to the following instructions to obtain CPE credit. To receive credit, you must be in attendance for a minimum of 50 minutes. No credit will be awarded from watching the replay. Accounting Today is not responsible for late arrivals or connections issues. There will be required polling questions asked periodically throughout the session, all of which you must answer. Please remember to click submit after choosing your answer. If you have completed the above, please allow up to 3 business days from date of today's session to receive an email from simplecert.net. This email will contain instructions on how you can download and print your CPE certificate. To ensure email receipt, please add simplecert.net to your safe sender list. Please note, CPE certificates will only be sent to those attendees who've registered and stayed for at least 50 minutes and answered all required polling questions. If you're watching in a small group, the person logged into the program is a small group facilitator. He or she must respond to the polling on behalf of the group and must monitor, document, and verify the active participation of the individuals in the small group. Please have the small group facilitator email support@virtualvenues.com within 3 business days a list of names, emails, and company of those registered in the small group for them to receive credit. And now I'm very pleased to introduce today's speakers. We have Matt Waters. He's CPA and Director of Lease Accounting at CoStar. Matt, I'll let you introduce yourself.
All right. Thanks, Danielle, and thanks for having us back. Welcome, everybody. Glad to be here today. We're talking about ESG in the accounting profession. And as Danielle mentioned, my name is Matt Waters, and I'm a CPA. I work at CoStar Real Estate Manager. And formerly, I worked at the Home Depot and another big company called American Tower. American Tower is actually one of the largest REITs or real estate investment trusts in the world. And it's a cell phone tower company primarily. At both of those companies, I led accounting teams and really primarily in the area commonly called real estate accounting. So managed lease accounting teams and also energy accounting teams. And so we will definitely today be leaning a little more heavily on the energy and the environmental side of the ESG discussion. But we'll talk a little bit about lease accounting as well today, because there's a lot of similarities in the changes that have happened over the past, well, really decade or so. And now for about the past 8 years, I've worked at CoStar Real Estate Manager. There we have helped over 1,000 companies at this point go live with a automation, software solution for lease accounting and lease administration. And we also now have an ESG component that our customers are utilizing. So we'll talk briefly about that a little bit later today. But as we get started, I'm really pleased that Kelly Anirudh from RGP has joined us today. Kelly's an expert in this area. She's been following the ESG discussion for some time. And Kelly, thank you for joining us. And over to you for your introduction.
Well, thank you, Matt, for having me, and welcome everybody. It's a real pleasure to be here today to talk about a topic that I'm super interested in, and that's ESG and sustainability. So I've been with RGP since 2017, where I've been leading scores of system implementation projects, mainly supporting our clients in becoming compliant with the new lease accounting standards. And before RGP, I worked with the development of the International Auditing and Assurance Standards, and I have a background in auditing, project management, and strategic human resource management. So I'm really happy to be involved in RGP's activities related to ESG and sustainability and to be here today. Thanks.
All right, thank you, Kelly. Okay, so just by way of overview, this is where we're going today. We're going to talk a little bit about ESG and what that means. Definitely, we're going to talk about the new SEC developments of the last week. We're going to talk about how ESG relates to accounting and the profession in general and opportunities for us as accountants. We're going to dig in a little bit into ESG reporting and some strategies, what you can do now regarding reporting. And then we're also going to talk about beyond reporting, some other maybe ideas to think about, because reporting, I think, gets a lot of the attention as it should, but there are some topics beyond reporting that we'll discuss at the very end. So diving in here, we're starting with our overview. I'm sure it is no secret that the SEC has released their new climate rule. It came out last week, and much talked about for a couple of years now. And but now we have the rule. It's a little bit different than the proposed rule, and Kelly has graciously agreed to give us a whirlwind tour of what the rule says. But again, no big surprise, I'm sure, to those of you on this call that that we now have a SEC regulation that was finalized for ESG. Now, ESG is an acronym. There are many acronyms in this presentation, and we're going to do our best to demystify and give those to you as we go along. ESG, of course, stands for environmental, social, and governance. And a lot of companies, even before the SEC came out with this rule, a lot of companies have already been voluntarily disclosing ESG-related information. CoStar Group, the company that I work for, is no exception. We're a public company, and we've been disclosing ESG information. You can see a copy of the the cover of our report here, and a lot of public companies have been doing that to get prepared and for upcoming regulations, and also just frankly because they deem it important. And so you'll see that if you go to the investor relations page, usually of a lot of public companies, you'll find a similar looking report to the one that CoStar publishes. Interestingly, and I'll hand it over to Kelly now, but RGP has a similar report on their website.
Yeah, RGP is listed on the NASDAQ, and we've been doing voluntary sustainability reporting for a while now. You'll find that information on our website. We report on 4 main topics, typically. One is environmental goals. The second one is diversity, equity, and inclusion. We report a bit on integrity and transparency, and then on data privacy. And really feel that the reporting is in line with our values of being a human-first organization. And that means making a positive impact, as you can see here, by taking care of each other and the world around us. So back to you, Matt.
Yeah, excellent. And I know you mentioned we dive in a little bit more into acronyms. So Kelly's been kind enough to prepare this slide.
All right. Thanks for advancing that, Matt. So ESG, and thinking of the who, what, when, where, why, and how, right? What is ESG? So first of all, I think it's important to just emphasize that it's not a new concept. It's been around for about 20 years. I like to think of it as relating to the concept of a stakeholder economy, which is broader than just a shareholder economy. And that means these days organizations need to consider the broader group of shareholders and stakeholders, and these include their employees, customers, vendors, potential recruits, NGOs, and the communities in which they operate. I typically like to think of ESG as a sort of a framework that gives a structure, and it has 3 pillars: the E, the S, and the G. So the environmental, that's really, what impact does your business operation have on the environment? And likewise, what is the impact of climate change on your company and its business and industry? And some examples of that, emissions, pollution, the impact on natural resources like deforestation, water, that kind of thing. Then the S, the social, the relationship with people, the community in which you operate, and society in general. And that would include things like diversity and human rights, health and safety, and data privacy. And then you've got governance, which relates to the way the company is run, how it's managed, including business ethics, executive remuneration, and board diversity. And sometimes folks wonder and ask about what's the difference between ESG and sustainability. And while they're related, I like to think about ESG as the framework that gives structure with the 3 pillars. And then sustainability is like a broader concept that even relates to behavior. And in fact, a definition of sustainability was developed by the United Nations Brundtland Commission in 1987. This commission was led by Gro Harlem Brundtland. She was a former Prime Minister of Norway. And the commission worked on developing the UN's Sustainable Development Goals, the SDGs, which are a framework to improve the lives of populations around the world and mitigate the hazardous impacts of climate change. So in many ways, I think the ESG and sustainability, they're related topics, and they both have kind of become a social license to operate in today's world. So we can move to the next slide.
Thank you. I wanted to say on this one, Kelly, first of all, I am very impressed at the pronunciation of that Norwegian name. Way to go. That was great.
I lived 25 years in Norway, so.
Oh, okay. There we go. That explains it. But I think a lot of people, have, with the acronym ESG and, the headlines that it's been making the past, couple years, I think a lot of people have considered this as kind of a new development. But then I like the way that you broke it down, and explaining the 3 pillars. And I'm even thinking, back to my time at Home Depot, which has been, over 10 years ago. Like when I started, it's been almost 20 years ago actually now. But back at Home Depot, we had initiatives focused on environmental aspects and utility consumption. I mentioned in my introduction, I managed the energy accounting, and so we had initiatives to minimize the amount of energy that we used in our facilities. Same thing at American Tower. At Home Depot, I remember a project that I worked on to make sure that we were keeping track of all of our pallets. I mean, just imagine how many wooden pallets the Home Depot uses, and the effect that can have, on the environment. So we had initiatives to manage that, and a lot of it was focused on environmental considerations, and then this goes hand in hand. A lot of those initiatives also saved a lot of money, right? So I think that's a theme that we'll see develop. And then, at Home Depot also, I remember we had, diversity and inclusion initiatives that I even served on some panels related to that, in those days. And governance, I mean, for the CPA profession, for sure, business ethics is required. CPE, everybody, or at least most people here, I think, are here getting CPE credit today. You're probably very familiar already with the concepts of ethics. And so I think it's just interesting to me, and just wanted to point out that while this acronym, and who knows, I've heard a lot of talk lately that ESG is maybe not even the right thing to call this body of knowledge and this, all the initiatives worldwide that we're hearing about now. Maybe we'll have a new name in the future, but hey, at least for me, I think it's encouraging to know that a lot of this has been, we've been really used to it for some time now, and actually working towards this together, for quite a while.
You bet. Been doing good things without really thinking about them in the context of ESG anyway.
Right.
So we just talked about the what. What is ESG? So here's the why, the who, the when, and the where. So in addition to this shift to the stakeholder economy, like we were talking about, we're also seeing a shift from voluntary reporting, like CoStar and RGP have been doing, to mandatory reporting, like you see here in the headlines related to the SEC and California regulations. But rather than just thinking of this as a compliance requirement, I kind of like to think of it as, compliance plus opportunity to do something good. So sustainability reporting gives the opportunity to not only reduce risk, but also enhance customer relationships, attract and retain talent, satisfy investors, and achieve ratings. It provides access to markets and investment opportunities and can even serve as a catalyst to innovation. We've seen that in the Norwegian energy sector and the offshore drilling and, offshore platforms, and a lot of innovation being driven there. And ultimately, of course, to create value. And I think there, consumers, especially the younger generations, really want to hear about companies' sustainability activities, and it can influence their decisions on whether to use the products or not. So a great example, I think, of a sustainability initiative is the headline here that you see about Walmart and their Project Gigaton. So this project started in 2017, and Walmart, they worked together with their suppliers, their vendors, NGOs, and other partners. The goal was to reduce or avoid 1 billion metric tons of CO2 equivalent by 2030. And the amazing thing is they achieved their goal last month in February of 2024, 6 years ahead of schedule. So they looked at things like, energy, waste, packaging, transportation, the impact on nature, and product use and design. And I think achieving their goal early, it doesn't mean the end of the initiative by any means. I think it means that they're just really off to a fantastic start. It's very inspiring, I think, to see what you can do. What are the possibilities when you really focus on something and work together with others to make something happen? And then the headline we've selected here on Coca-Cola. This headline focuses on the circular economy, and that means an economy that aims to eliminate waste and maximize the reuse of resources. So Coca-Cola, they're building KPIs and sustainability metrics into their executive compensation schemes because, what gets measured gets done. So I think from my background as well, from the HR side, for me, it's really interesting to see that link there. Actually, this is driving behavior and driving performance in the realm of ESG and sustainability.
Yeah, absolutely. And kudos to Walmart for congratulations for meeting that goal. That's impressive. Also interesting, the headline here about SEC approves the weakened climate disclosure rule, and basically it changed a little bit, as we mentioned, but and Kelly's going to dive in. When you see the next slide, you're not going to think it's very weak, I don't think, but hey, it did change. It's different than some of the rest of the world, but I found that interesting. That's kind of the way things went for lease accounting. In the U.S. with ASC 842 went a slightly different direction than the rest of the world did with IFRS 16, right? So we're used to this in the accounting profession, and I think it will create some interesting discussions about how to organize data going forward, and we'll talk more about that as we continue to dive in.
You bet. So the next few slides, there are several, are intended to give you a high level overview of some relevant regulations, standards, frameworks, things like that, here in the U.S., but also internationally, the ones that have served as models for some of what we're seeing in the U.S. So as Matt mentioned, the hot topic this past week was the release of the SEC's final rule on climate-related disclosures. This rule has been 2 years in the making since the time the proposed rule was issued. They received something like 24,000 comment letters, and like 4,500 of those were unique letters. So there was a lot to plow through. The final rule was only 886 pages long. And even executive summaries that I've seen, they're, like 8 to 10 pages. The fact sheet itself, which is referenced here on this slide, is 4 pages long. So this rule could easily be the topic of an entire webinar or more than one on its own, but that was not the intention with our webinar today, although the timing was really, really great. So as an introduction, we've done a little bit of research to point out some of the highlights. This is our attempt to reduce 886 pages to a single slide. So please bear that in mind as you look at it. And please do check out the resources that are available in the authoritative literature. As I mentioned, there's a link to the fact sheet here. So first of all, we might start by asking, why even have this rule? So there have been studies, and one was done by the Carbon Disclosure Project, that showed that companies that effectively manage and disclose their environmental impact see an average of 67% higher return on equity than non-disclosing peers. So taking that a step further and thinking about what SEC Chair Gensler said in his comments, he said the rules will provide investors with consistent, comparable, and decision-useful information, and issuers with clear reporting requirements. So useful for investors and clear reporting requirements for those that have to disclose the information. And it's something like 12,000 companies that are subject to this rule, and many are already doing some kind of voluntary reporting or some kind of reporting, perhaps in the European Union, like with the European Sustainability Reporting Standards. We'll touch on that in a minute. But compared to the proposal, as Matt mentioned, it's changed a little bit. There are 3 main areas just wanted to highlight. So one of those is that there is no requirement for Scope 3 emissions reporting. That was a very contentious area, and they have decided in the end that there would be no requirement to report on Scope 3 emissions. The financial statement disclosures have been scaled back compared to the proposal. And the third item, there's more time to implement than was noted in the original proposal. So in short, registrants will need to make climate-related disclosures in their registration statements and annual reports. And these disclosures and the related timing, it will depend on your registrant type. Like if you are a large accelerated filer or an accelerated filer or a non-accelerated filer or something else, that will influence the disclosures and the timing. There's something here for everyone, though. There are also some conditional requirements that are not mentioned here. So again, please do refer to the authoritative literature. The required disclosures include material climate-related risks. Now, material, what do we mean there? The last bullet here references the Supreme Court precedent that gives the definition of materiality that tends to be used in this context. So material climate-related risks and their impact on strategy, business model, and outlook. A description of board and management activities related to climate-related risk. Processes to identify, assess, and manage material climate-related risks. And information about material climate-related targets and goals. And then the large accelerated filers and the accelerated filers must disclose the material Scope 1 and 2 emissions and obtain assurance. And that starts with limited assurance. It's kind of a phased thing, starting with limited assurance, and ultimately for the large accelerated filers, reasonable assurance. Small reporting companies and emerging growth companies and non-accelerated filers are exempt from the emissions reporting. Then in the audited financial statements, there will be requirements for disclosures about severe weather events. Now, those severe weather events have not been defined, so that's an example of where you may need an accounting policy. What do you determine to be a severe weather event? And those are subject to certain thresholds, some de minimis thresholds there. And then if carbon offsets or renewable energy credits or certificates are a material component of meeting your company's climate-related targets and goals, then you need to also disclose sort of a roll-forward analysis, if that's material. Again, as we note here, disclosure of Scope 3 greenhouse gas emissions will not be required. The timeline has been extended, so it starts with a phased-in process starting in fiscal year 2025 for the large accelerated filers. So really just encourage you to check out the resources. And again, think of it as more than just a compliance requirement. Think of it as compliance plus opportunity.
All right, great summary. Thank you, Kelly. And I know we have a few more rules to talk through here, so I'm just going to keep it rolling on to California.
Yeah, so moving on to California, they sort of jumped the gun on the SEC. Since the SEC took a while to issue their final rule, they went ahead and enacted into legislation some climate-related rules in October, so 5 months ago. And there are 3 of them we'll just briefly touch on here. They relate to public or private entities doing business in California. Come back to that in just a second, that have revenues over certain thresholds. So when it comes to doing business in California, we're pending additional guidance on that. We expect there will be some implementation guidance around what that means in practice. But what we're hearing is that it doesn't mean that you have to be headquartered there or located there or even have a facility or an office there. But considering that California is something like the world's 6th largest economy, if you have revenues there, customers there, that may be enough to make you subject to this legislation. So the one on the left, Senate Bill 253, Climate Corporate Data Accountability Act. This applies to the entities with doing business in California with annual revenues over $1 billion. And it requires disclosure of Scope 1 and 2 emissions, and then on a phased-in basis, Scope 3 emissions. So this goes beyond what the SEC did. This is requiring disclosure of Scope 3 emissions. It also requires assurance, limited assurance in the beginning, and then progressing to reasonable assurance. The timeline for reasonable assurance for Scope 1 and 2 has been defined, as you can see at the bottom, on the bottom row, but for Scope 3 emissions, that's yet to be determined. I think they want to give themselves a chance to kind of see how that goes. The one in the middle, Senate Bill 261, Greenhouse Gases, Climate-Related Financial Risk. Again, companies doing business in California with total annual revenues over $500 million. And this relates to disclosures about the climate-related financial risks starting in 2026 and then every other year from then on. These rules are expected to apply to something like 10,000 companies. And the Scope 3 requirement is interesting because some statistics that I've seen say that 60 to 90% of a company's carbon footprint come from the Scope 3 emissions. So that's why so many folks consider them to be so important and why the disclosures are considered so meaningful. Back to the table briefly on the right, this Assembly Bill 1305, Voluntary Carbon Market Disclosures. This one sometimes tends to get overlooked, but it relates to combating greenwashing. And greenwashing, that's when companies are making climate-related claims. And maybe they're really not able to substantiate those or back them up. So that's what this bill is intended to target. It says that if you're making any net zero, carbon neutral, or emissions reduction related claims, or if you're marketing or selling these voluntary carbon offsets in California, you must provide details of those claims, including the basis for such claims. So you have to be able to back up what you say. And then if you have performed any third-party verification, you need to disclose details about that. And this one is actually already in force, entered in, and it applies from January 1st of 2024. So companies that are making these claims today and do business in California are subject to this.
All right, excellent summary again, Kelly. I think about this one. This is kind of familiar. I know over the years I've had to sign some annual compliance training type paperwork because of California specific laws. So far it's been around like data privacy and dealing with information, personal information of a California resident. But it just kind of reminds me of that in that California does sometimes get ahead and craft some regulations that really do apply to a broad sweeping group of companies.
Well, yeah, and watch this space because there's talk about New York, Washington, Oregon, and Illinois are states that I've heard mentioned that maybe have something in the works. I don't know how that they will be influenced now that the SEC rule, the final rule, is in place. So that'll be interesting to follow and see what happens there.
Yeah, for sure.
Okay. So thanks for advancing to this next slide. So the TCFD, again, the acronyms, and I know we've got a lot to get through, so I'll try to do as quickly as I can here, but without missing anything essential. So the TCFD, the Task Force on Climate-Related Financial Disclosures, it started in 2015 and was chaired by Michael Bloomberg. It's recently been subsumed into the IFRS Foundation and the International Sustainability Standards Board. It's a widely recognized framework. It's the basis for the International Sustainability Standards and the European Sustainability Reporting Standards. It's served as a model for California and the SEC climate-related risk disclosure requirements. What comes into play here is this concept of interoperability. And that means really don't reinvent the wheel. Adopting these regulations should not be onerous for the adopters. There should be a high degree of alignment and reduced complexity and reduced duplication for entities that may need to apply more than one set of standards. So that, for example, if you are in the European Union and also doing business in California, or if you're an international organization in Asia, but also have operations in the European Union. So you may be subject to different sets of requirements, but the idea is that they would generally, much of the underlying information is going to be the same. The difference is kind of how and where you're reporting it. And it's a lot of ways, I think, similar to what we saw with convergence activities around IFRS and US GAAP. Over the past decade or so, and then international standards on auditing and US gas. So building on lessons learned there.
Yeah, I've been saying for a little while that the new climate disclosure rules in whatever form were going to be a big opportunity for accountants. Then when this happened, the absorption into the IFRS Foundation, I thought, wow, I think that even kind of underlined that accountants, CPAs, are going to be involved in this, and we're well suited to be. We're going to talk about that more later, but I just thought that development really kind of underscored that fact.
Yeah. So where the TCFD applies to the climate-related risks and disclosures, you've got the greenhouse gas protocol here for emissions reporting and carbon accounting. So it was launched as far back as 1998 as a multi-stakeholder partnership. It represents a widely recognized set of standards and guidance and serves as a model for other regulations like California, like the SEC. The international standards, the IFRS S2 climate-related disclosures, mention the GHG, the Greenhouse Gas Protocol, explicitly. So although it may not be explicitly mentioned in the SEC rule, you can use the methodology and you must just explain what you've used. It introduces concepts like the organizational boundaries. So that might be an equity share approach or a control approach, like how much do you have to report on? It introduces the concept of operational boundaries, which may be direct, like your Scope 1 emissions, or indirect, like the Scope 2 and 3 emissions. So there's lots of guidance and examples from various industries. It's like a 116-page document or something, but there's all this additional guidance for different categories of Scope 3 emissions, like purchased goods and services, employee business travel, and upstream leased assets. So really just trying to share with everyone all of the different things that are out there, the authoritative literature, the references, and the frameworks that are available, publicly available as well.
Yeah, 116 pages. That sounds like light reading now, compared
Yes.
to the SEC reg, right?
To others. And very briefly, then we've got the international standards here. The International Sustainability Standards Board issued its IFRS S1 and S2 back in July of 2023. These have served as the model for Europe and are becoming more widely adopted even in countries outside of the European Union, like the UK, Brazil, Mexico, Canada, Singapore, Hong Kong, Japan, and the list continues to grow. On the right, you've got the European standards, the European Sustainability Reporting Standards, much broader and relate to many aspects of ESG, like climate change and water, workforce and consumers and business conduct. So these, again, have the potential, the European standards, to have the potential to impact something like, I've heard, 3,000 US companies that have operations in Europe. And just even recently, very recently, in the past couple of months, the IAASB issued its exposure draft of International Standard on Sustainability Assurance, ISSA 5000. That standard tells you how to audit a sustainability report. And then the ESBA issued an exposure draft, International Ethics Standard for Sustainability Assurance, the IESSA. And the interesting thing with it is it's profession agnostic. So not only does it apply to accountants, it can be used by engineering firms, valuation firms, folks helping with, the carbon accounting, let's say. And it also requires independence. So that was the world. Well, we've got one more. Sorry, almost there. The COSO framework. So finally, with regard to frameworks, the COSO publication, Achieving Effective Internal Control Over Sustainability Reporting, it updates and expands on a 2017 study done by COSO on sustainability performance data, and it applies those COSO principles and the risk and controls framework to sustainability. And it's going to be very important, I think, for companies in thinking about audit readiness and when all this information is going to be subject to assurance. And some of the key takeaways that you see here, really, the last one, start early. I cannot overemphasize that, I think, based on what we saw with lease accounting as well.
All right. Wow, way to go, Kelly. Thanks for the tour of the standards in just a few slides. Danielle, I think we have our first polling question now.
Indeed, we do. It is time for the first polling question. The question is, what is your company's status regarding ESG reporting? Your choices are A, we already issue a complete ESG disclosure. B, we publish some information, but we may increase our disclosures. C, we are just starting to look into ESG reporting. Or D, other, don't know, not applicable. So you have 4 choices here. Please select the option that best applies to the question of what your company's status is regarding ESG reporting. And this is your first polling question. I know we had some people asking in the question and answer panel. You didn't miss any polling questions. This is your first one. So make sure you get your answers in. Once again, just to give everyone adequate time, what is your company's status regarding ESG reporting? A, we already issue a complete ESG disclosure. B, we publish some information, but we may increase our disclosures. C, we are just starting to look into ESG reporting. D, other, don't know, and A. So I'll give everyone a final few moments to get their responses in. We want to turn back to the presentation. We still have a lot of good information to get through. So I want to make sure we get back to some of the insights we've heard so far. But I will close out this polling question. I'll give everyone a final 5, 4, 3, 2, 1. And there we go. I'll turn it right back to our presenters so we can dive right back in.
Thank you, Danielle, and thanks everybody for responding there. And don't worry, we will go more rapid fire to the next polling questions. That was just a good natural spot for that one after the summary of the standards. Now we're going to talk about ESG and accounting, a little bit more about how it affects our profession. And I believe, as I wrote in a blog post that you can find on our CoStar Real Estate Manager website, I believe it'll boost the accounting profession, and really just because we are quite used to dealing with complex regulations and requirements. We're right here on the heels of revenue recognition and then lease accounting. We're quite used to ingesting those rules, collecting data from all around the organization, and then presenting data in an auditable format that in ESG in some ways is not very similar to financial data. In some ways, it is extremely similar to financial data. But either way, I think with the with the need for this to be auditable, the data related to ESG and the reporting will need to be financial grade. And so accountants and CPAs are quite used to this, and I think are well suited to actually have an opportunity associated with ESG. Kelly, what do you think about that?
Yeah, no, Matt, I totally agree. I think it's a great opportunity for accountants, and also it's a topic that I think that many, maybe especially the younger generations of accountants, will find both meaningful and inspiring, even more inspiring than debits and credits, No, so I think it's going to give a lot of interesting opportunities, and accountants, they've got those analytical skills. They're used to working with data, technology, frameworks, reporting and disclosures, like you said, and also, how to effectively communicate about those kinds of things. And we see, more and more companies now also with advertising, ESG controller positions. So it's actually becoming an important role in many companies as they, proceed down the tracks with these reporting requirements.
Yeah, I mean, it's hard to get more stimulating than debits and credits, but hey, we'll see. We'll see how it goes. I think that a lot of the stakeholders that we talked to as we kicked off lease accounting projects, I started this list that you see on the screen now from my experience at Home Depot. What we did there in the very beginning when lease accounting was just in the exposure draft phase, we got together a cross-functional group of stakeholders, and I first started by inviting a group of stakeholders from all different departments around the organization. I booked a conference room, and then people started getting added to the list. And I realized with lease accounting, at least, in those days, the list actually got so big with stakeholders in different departments, I had to book a different, bigger conference room, that kind of has the tiered seating. And, so I think that will prove to be true with ESG reporting as well. And, as companies dive into these projects, I think these, a good, first step after reviewing through the, the frameworks and the requirements will be to put together a cross-functional group and schedule a meeting like that. And a lot of the stakeholders that you might want to consider including are listed on the screen.
Yeah, Kelly, I agree, Matt. I like to think of it, it's like a relay race. And the accounting and finance folks, they're going to take the relay baton the final mile. They're going to do the disclosures. They're going to do the reporting. But they're going to rely on all these other folks listed here to provide them with the information that they will ultimately report on and be on the hook for, And the list has only grown since lease accounting. For example, we see here energy management at the bottom. We see sustainability. We see the HR department, because they're going to provide information about the S and the G for those that are reporting on that. So definitely requires a holistic, collaborative approach.
Absolutely. Danielle, back to you.
Thank you. It is time for the next polling question. Your question is, where do you think most data will come from for ESG reporting at your company? Your choices are A, real estate related environmental data, B, equipment related environmental data, C, other category of environmental data, D, social or governance data, or E, don't know NA. So I'll give everyone a final bit of time to get those answers locked in. You have 5 choices here, so please select the choice that best describes where you think the most data will come from for ESG reporting at your company. And just once again, so everyone has time, the choices here are A, real estate related environmental data, B, equipment related environmental data, C, other category of environmental data, D, social or governance data, or E, other, don't know, not applicable. So I'll give everyone a final few seconds to get those answers locked in. A final 5, 4, 3, 2, 1. All right, and Matt and Kelly, back to you.
All right, thank you. Thanks, everyone. So now we're going to talk briefly about ESG reporting and just some strategies to maybe get you started down this path. If you aren't already, and hey, if you are, maybe some categories that you might want to think about adding. Kelly?
Yeah, so here what we're showing is a sustainability reporting cycle, the kinds of things, that you need to think about and what this is going to look like in practice. So similar to lease accounting in many ways, I think it's going to be somewhat of an iterative cycle, but you need to start by thinking about your priorities and figuring out what are your material topics. And then based on those material topics, setting goals and targets and defining and establishing metrics so that you can measure your progress toward the goals and targets. Then at the bottom, data. That's a big area, the identification, collection, analysis, and validation of the data and conversion to CO2 equivalents or whatever it is that you're going to have to report on. Then establishing and documenting your processes and controls around all of this. Ultimately performing your reporting and disclosures and submitting that to assurance if that's the requirement in your particular circumstances. And that's going to require, I think, a lot of information gathering, conversations, discussions, analysis. Also, at the end, you're going to need to step back, kind of reflect and reevaluate, are the material topics that we identified, were those really the ones, or did we learn new information along the way? And we need to reconsider that. And for all of these things, then having a robust technology solution that will help you perform all of these activities. We saw with lease accounting, some tried to go it alone without a technology solution. And that didn't always go so well, especially after the first year of assurance.
That's right, Kelly. I mean, we saw with lease accounting, and we will see with ESG, emails back and forth and saving those and then using manual spreadsheets is not going to be the way to do this.
Yeah, because when it comes down to a lot about data quality, and that's really, so I like to think of ESG, I kind of think of it as an elephant. It's massive. It's a massive subject matter area. But like lease accounting, the data is going to really be the heavy lifting. So that's like, the elephant's trunk. But the data is also like the longest line on the project timeline. And this survey by Deloitte highlights this, 60%, the 35 plus the 25, 60% of executives that have been through something similar to this have said that the quality of data and access to ESG data represent their greatest challenge. So again, we really recommend you to get started early and start thinking about your data.
Yeah, that was the number one lesson learned from me talking with hundreds of companies, during and after lease accounting transition. The number one lesson learned was we wish we had started earlier. So I'm glad you bring that up. And I know here you have some steps to get started.
To help folks get started early. Don't wait, get ahead of the game. It will reap rewards, because I think expectations around this type of reporting are likely to increase, not subside. We'd encourage folks to consider performing a compliance readiness assessment. And this is something that RGP, we help our clients with this. Really start thinking early about that executive buy-in. Who is going to be your executive sponsor? How to set the tone at the top and give this the priority that it needs. And experience from Europe is really showing that's going to be very important for a successful result. Put some project governance and management around it. Very important. Determine your requirements. Are you subject to the SEC rule, the California rules, the European standards, the international, some of the above, all the above? What requirements are you subject to, and who is going to help you get the information that you need to ultimately disclose? So performing that stakeholder analysis, and Matt showed us the long list of the stakeholders. Identifying your data sources so that you can already think about, where is this data? Where does it reside in my organization? Who controls it? What format is it in? Is it structured, unstructured? How similar is it or not to financial data? How are we going to get a central repository or get it all into some format for reporting? And then thinking about your current or as is processes, controls, and the technology solution that may help you do that. And then ultimately, performing a gap analysis and developing a plan or a roadmap to help you along the way to achieving that goal. So I think this is another example of what a great career opportunity for those in accounting finance, because it's really going to be in high demand. Data is going to take a long time. It's going to require cross-functional collaboration, and accountants are well placed to help with that.
For sure. And one thing that we can do to help you at CoStar Real Estate Manager, our product team and our developers have worked really hard, just like we did for ASC 842 and IFRS 16 before the final standard was issued. We have developed a place for you to start. So right now, some of our customers are actually already using this ESG reporting module in CoStar Real Estate Manager. They're capturing risk factors, environmental attributes, certifications, related to the buildings, utility consumption data, green lease clauses, and many other data points. And this is something that continues to evolve, and we continue to get great feedback from our customers and our peers and partners like RGP and Kelly. And so look for this to continue to be an offering from CoStar Real Estate Manager. And if it looks interesting to you, of course, we'd be happy to show you more and give you a demo of it at any time. Danielle?
Yes, thank you. It is time for the next polling question. Your question is, do you plan to use a software for capturing ESG data? Your choices are A, no, we plan to use manual spreadsheets. B, yes, we mainly plan to use our ERP software. C, yes, we are using specialized ESG software that we already purchased. D, yes, but we haven't made a decision on software yet. Or E, other, don't know, NA. Make sure you get those responses in. Just to let you know, there is another polling question that we will get to before the end of the hour, so stay tuned for that one. But make sure you get your answers locked in for this one first. Again, the question is, do you plan to use the software for capturing ESG data? Your choices are A, no, we plan to use manual spreadsheets. B, yes, we mainly plan to use our ERP software. C, yes, we are using specialized ESG software that we already purchased. D, yes, but we haven't made a decision on software yet. Or E, other, don't know, not applicable. I will give everyone a final few moments to get those responses locked in. A final 5, 4, 3, 2, 1. And it looks like about 60% say other, don't know. Matt and Kelly, I'll turn it back to you.
All right. Thanks, Danielle, and thanks, everybody. So now for the last section here, and then we'll get to our last polling question. We're just going to give you some quick thoughts about beyond reporting. I know reporting is top of mind right now, but there are some other things to think through. I think one of them is the tax considerations around this, and we mentioned the tax department on the list of stakeholders. I do think it is important to bring your colleagues in tax into the discussion. SKU level traceability is something that we've heard about. Again, this slide is really just for kind of food for thought. Do you know where every asset is, and can you track it? At least accounting helped a great deal with this, but hey, if for something to have a carbon footprint, it probably is an asset. And do you know where it is? Can you track it? Better data is equal to better decisions. To the extent, I think this is just another encouragement to get started early is the main point here. Know where your data is, start to organize it, get it into a central repository, as Kelly mentioned, and you'll be ahead of the game and be able to make better decisions and have better reporting, on top of that. Risk is another component of this. It's not just about, tracking and reporting. It's also about minimizing risk. So another area to think about and perhaps help inform who to talk to within your organizations as you're setting up that list of stakeholders. And then finally, I'll just say the bigger picture, the good that this type of activity will bring is of course something to think about, and Kelly did an excellent job of describing that, and also like I mentioned earlier, a lot of times you're saving money too, so it's you'll hear as you read and listen to webinars and other resources about this, you'll hear the concept of double materiality. And I like to think of that in terms of the example I gave earlier, the pallets. We saved a lot of money at Home Depot, and that was material to that line on the financial statements. We also saved a lot of trees, right? So double materiality and the bigger picture is something to keep in mind. All right, Danielle, our final polling question.
Yes, it is that time. Thanks, Matt. The final polling question is, do you think ESG reporting will ultimately improve your business results? Your choices here are yes, but only the non-financial results. B, yes, financially and non-financially. C, no, it will just be busy work for us. Or D, other, don't know, and A. So once again, we are asking, do you think ESG reporting will ultimately improve your business results? You have 4 choices here. Your choices are A, yes, but only the non-financial results. B, yes, financially and non-financially. C, no, it will just be busy work for us. And D, other, don't know, not applicable. I'll give everyone a final few moments to select which of the 4 choices best describe how you think ESG reporting will ultimately improve your business results. Make sure we get all those answers in before I close out the poll. I'll give everyone a final 5, 4, 3, 2, 1. And it looks like we have a good mix there. So interesting results there. Let me make sure I get this slide up here so people know how to contact Matt and Kelly. I want to thank Matt and Kelly for such a great, informative presentation. You got a lot of information in there. And thank you for the audience for being so engaged with everything. I think we have a final minute if Matt and Kelly, if you have any closing thoughts, but otherwise, covered a lot of ground.
Thank you. Thank you very much. Thank you, Kelly. Thank you, Danielle. And thanks everybody for joining.
Yeah, thank you all so much.